Understand volume and volatility in cryptocurrency. Trading contains substantial risk. By watching this video, you agree to the terms within this disclaimer and accept full responsibility of your own investments. This lesson will focus on answering the following questions. Before we continue, pause the video, read through them, and be certain to minimize any distractions. When we think about how the market moves and what has to occur in order for our orders to be executed, whether we are purchasing an asset to physically invest and hold on to, or if we're not looking to accumulate a position and we're simply looking to trade on margin with some leverage involved, we have to understand volume and volatility in order to maximize our opportunity. Volume refers to the quantity of an asset that is being traded, and it goes hand in hand with volatility, which refers to the increase or decrease in price value. So the price of a cryptocurrency, it can change very rapidly, especially when there is an imbalance of orders. However, even if there is a high volume, if there is a large interest within that particular market, a balanced order book is going to result in low price fluctuations. We're not going to see as high of a level of volatility if there are many people participating in that particular market. Each exchange is going to have different levels of volume, and you may notice price differences depending on where you are looking to trade that particular asset. And there must be liquidity in order for our trades to be executed into any market. When there is not liquidity, you may find that price freezes. You may find that you experience what is called slippage, and you do not get filled at your original anticipated price. These are common, but can be mitigated and potentially avoided completely with the utilization of limit order positions. Let's go ahead and take a look at the charts so that we can see a few examples of volume and volatility in action. Right now we're looking at Ethereum on the hourly chart. Some of these candlesticks may seem insignificant when we're considering how much price changed over that hour. When we come down onto a smaller time frame to backtest for accuracy, we are able to identify that in these moments, we were experiencing a low level of volatility because the order book was fairly balanced, regardless of how much volume was actually occurring. When we look at this as an example, this candlestick opened at 1743. The one immediately to the right opened at 1751. So there was some delay in how long it took for each candlestick to open. And we can see that price will consolidate and accumulate more orders, sometimes for hours at a time. Let's backtest a little further here on MetaTrader and take a look at another example. Over in this area, this price of $573, we can see that price stayed at the $573 area for around 4 hours. Now, when we look at this candlestick right here, it opened at 1210. Coming to the next candlestick immediately to the right, it opened at 1221. So there was an 11-minute difference. And those candlesticks did not print because price did not change. There was no volatility in that moment, regardless of how much volume was moving into the market. Now, when we compare this data with TradingView, we're going to see similar candlesticks on the hourly or other time frames, but coming down into the minute chart, the difference is that they are going to print every single candlestick regardless of if the price changed because there was volume occurring in those moments. If we come back to where price was accumulating orders around the $573 area, during this whole period of time, there was a fairly large amount of volume. And we can easily identify that by taking a look at the volume bar down here. And we can see that in this 1 minute, even though price from high to low only changed 36 cents, the volume in that minute was over 5,200 Ethereum traded on this one exchange. So price only moved about 3 pips, but there was a balanced order book which resulted in the volatility remaining low for that moment. However, we can look left and see another minute stick over here where there was about 4,900 Ethereum traded and price from high to low moved almost 90 pips. So in that moment, there was a different structure for where people were willing to buy and sell at. And that is how you read volume bars. You're simply going to be able to look at this information on smaller time frames. Whenever you do go to a higher time frame, it's going to consolidate that data for you. So now you're going to be looking at how much volume occurred over an hour, how much volume occurred over 4 hours, etc., when you're considering other time frames as well. And remember, cryptocurrency still is a very new and emerging industry. Right now, we're dealing with billions of dollars in volume every single day, diversified throughout the entire space, whereas the foreign exchange market is doing trillions in dollars of volume. The difference is that because cryptocurrency is still new, although both markets are speculative, we have to understand that there are specific moments in time where the cryptocurrency space requires a very small amount of volume to significantly change the price. This will result in us being able to see movements upwards of 500 pips in a single minute. Just imagine what it would be like to find yourself in that sort of a position. In summary, market participants around the world contribute to the price movement that you see occurring within the candlesticks. If there is low liquidity, orders may not be filled. And just because there is a high amount of volume does not always result in high volatility. Understanding these two concepts and allowing yourself to gain more experience, both using the order books and physically seeing the price move on the chart, is going to help you become a better trader in the long run. Be sure to leverage the resources made available to you, and the most important thing is to stay plugged in. As you implement the information, ask questions and remain open minded, because all trading requires is persistence, discipline, and acceptance that you can and will learn this skill set.